Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And good morning, it's Kerry Lutz on the Financial Survival Network. It's December 15th, Monday, 2014. Lots to talk about. Unless you've had your head totally in the sand, you've seen what's played out in Washington. We've got John Rubino, dollarcollapse.com, co-author of The Money Bubble, with us now. John, good morning.
Morning, Kerry.
Hey, so what about that Congress, huh? They're leaving shortly. Well, a lot of them are going to be gone, not coming back, but they got to get their last licks in, got to get that last paycheck. And your article, Well Played Wall Street. Well, my take on it is Dodd-Frank is dead. Long live Dodd-Frank, huh?
Yeah, you have to congratulate the big banks, Kerry. They played this beautifully. To set up the story, back in the previous financial crisis in 2008, the banks had, in the previous decade, been playing increasingly extensive games with really risky instruments called derivatives. And things got out of hand, the derivatives blew up and almost took down the entire global financial system. And so the banks coerced the government into bailing them out. And one of the prices that they had to pay for that was that Congress created a new law called Dodd-Frank that, among other things, required the banks to move their derivatives trading out of the divisions that are guaranteed by the FDIC. In other words, they couldn't play derivatives games with federally guaranteed deposits anymore. And the banks hated that because they love having this cheap money to play with. So this time around, in the last election cycle, they flooded money into Washington. They were the biggest campaign donors to the Republicans. They got a whole bunch of Republicans elected. And now, even before these new Republicans come in, they were able to basically rewrite Dodd-Frank to eliminate that pesky little provision about them having to do their derivatives trading in non-insured divisions. And so they got that taken out. So now it's basically back to square one. They can do anything they want to with their derivatives trading. And if it blows up, which it completely, totally will at some point in the near future, taxpayers have to bail them out again. And the timing of this was perfect because as this law was being changed, a lot of risky paper is going bust right now. We've got the energy bonds. The junk bond sector is heavily weighted towards shale oil and fracking and things like that. And that's all blowing up now that oil prices are going down. And so that's a big risk to the banks. And derivatives are heavily weighted towards interest rates right now out in the world. And interest rates are being very volatile, which is probably creating a lot of loss positions for hedge funds or big banks or whoever is on the wrong side of these interest rate moves. So it's completely possible that in the coming year, derivatives are going to blow up again. And so Wall Street was able to put taxpayers back on the hook for this just before it was going to happen. So really, I mean, it was a brilliant move. You got to give them credit.
Yeah. Well, it's Wall Street. This is what they live for. This is why their lobbying budgets are, in the hundreds of millions, billions of dollars. And, they're really not competitors when you get down to it. Not when it comes to Washington. They join forces and they got great parties. They just own DC. That's what it comes down to.
They can throw enough money into crucial campaigns to elect who they want to elect. And that's the message that Congress has taken from the past election. So even the Democrats who were on the other side of a lot of this have decided to fall into line now. And so there were enough Democrat votes in the last set of negotiations to allow this law to pass. And it was over the objections of a lot of people at the fringes of both parties. You got the libertarian wing of the Republican Party who doesn't like this kind of thing, and you've got the liberal wing of the Democrat Party who were opposed to stripping important provisions out of Dodd-Frank. And they both got steamrolled. So, the mainstream of both parties is now totally in the pocket of Wall Street. And so what happens next year is that there are other provisions of Dodd-Frank that Wall Street doesn't like. And if they got this in without the Republicans who have been just elected even, showing up yet. When those guys move into their new offices and start crafting legislation, you've got to figure that the rest of Dodd-Frank is now at risk. And, you can make the case that it was a stupid law in many ways to begin with, and it was ineffective and all the rest. And, a lot of that criticism of Dodd-Frank is probably true. But the bigger picture is that the banks are now so in control of the process that they can get pretty much anything they want to. And history has shown that once you turn them loose, they basically spin out of control because these guys are focused on next year's bonus pool. And if you can generate huge fees by creating a lot of new derivatives, and that pumps up your earnings, which in turn pumps up the bonus pool, that's what they're going to do. And so they will increase leverage and increase the size of their derivatives books and lend money to basically anybody with a heartbeat if they're allowed to. And so basically they're going to be allowed to starting really now and accelerating into next year. So if there wasn't a gigantic financial crisis coming, then there definitely is going to be a gigantic financial crisis coming now once they get freed from all the restrictions or the minimal restrictions that were imposed on them in the last few years.
Yeah. And this is nothing new here, but arguably there was one good thing about Dodd-Frank, and that was the part that restricted them from gambling, playing the derivatives game with depositors' money. And now, everything else, in my opinion, was a lot of garbage, wasn't going to stop another financial crisis because it's just like things like the Consumer Financial Protection Bureau. All the authority that bureau has is not is vested elsewhere. Like for credit cards, the FTC's got a lot of that. And for mortgages, the Fed has it. All the jurisdiction that Financial Protection Bureau has is vested elsewhere. It's a joke. The Bureau is a joke. It's totally unnecessary. But the Volcker rule and the derivatives trading rule, that really made a difference. And stripping them of the prop trading desks for commodities, over time, that could make a difference. But this thing, boy, forget about it. It really was going to make a difference and really had the potential to make a difference. And look where we are now, back to square one, right?
Yeah, well, two things. One is that regulatory agencies are all about the people in charge. And eventually, the way it works is that you end up with people in charge of regulatory agencies who are creatures of the industries that are being regulated. In the U.S. right now, if you're a regulator, that's basically an extended job interview for the next thing that comes along, which is to become a lobbyist for the industry that you were regulating or a high-level executive there. And so that's when you make your real money during your career lifetime. So you're not going to do anything to cross the industry that is going to be your bread and butter, is going to sign your paychecks in the following decade. And that's the way it always works. So it would have been no different with the Consumer Protection Agency in finance, because it would have started out with some teeth and then would have turned into a pussycat, something that is a creature of the finance industry. So yeah, we can't get away from that. And the only way you can get away from that is to shrink the size of the government to the point that it can't hand out goodies that make it worth corrupting. And then maybe apply, I know this isn't really the libertarian line, but I'm becoming more and more partial to strict antitrust laws going forward, where you just set an arbitrary limit on the size of entities in a given industry. And you say, okay, no bank can be more than $100 billion in assets or whatever. And yes, it's arbitrary. Yes, you lose some efficiency, blah, 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 but you gain competition.
Yeah, which is desperately needed. So antitrust definitely keep these bankers from getting too much power over the system. Keep them small because, and if they need to make big loans, let them go syndicate the loans, right? They know how to do that.
Yeah, because you can't do it by setting up regulatory agencies because they eventually are captured by the industries that they're supposed to regulate. So the question is, what do you do then? How do you keep private sector power from concentrating to the point that it takes over the public sector, and then you get a public-private partnership dictatorship? And that's what capitalism will always tend to if you don't maintain competition. And so that's the big overarching debate that we'll have to have after everything blows up. Now it's too far gone. The system can't be fixed, as this is a perfect example that we're talking about now, where even if you pass a law that has some decent provisions, if you haven't broken up the big entities that you're trying to regulate, they will eventually finance an election campaign that gives them back the ability to strip the onerous provisions out of that law. And that's exactly what we should expect. Piecemeal regulation of entities as big as today's banks will never do you any good because they're too powerful to let it stand for very long. So in the financial sector in the U.S., you got to go all the way back to the concept of fiat currency and change that, first of all. Go back to pre-1971 at a minimum rules and regulations in the U.S. where the dollar is linked to gold. And that limits the amount of new currency that can be created, which in turn limits the power of the banks that get that currency first. And in that way, you stop the industry from accumulating enough power to take over the government. But I would say, it failed because we'd already gone too far by the 1970s, and we should probably go back even further to a stricter gold standard like we had in the classical gold standard, where dollars and gold were basically the same thing. They could be exchanged for each other, and if too many dollars were created, they would be exchanged for gold. Your gold reserves would go down, and you'd have to change your economic policy in order to bring things back into balance. If we went back to something like that, governments of the world would scream that it was so restrictive and it's not letting them do what they want to do. But it would also limit the power of government and limit therefore the power of the big private sector entities that are incented to corrupt the government in the current situation.
Yeah, well, we've certainly seen our share of corruption. And hey, when we get back, we've got more to talk about because, hey, it's not fun being a fund manager at this point. Being a money manager on Wall Street, you're just getting your head handed to you on the Financial Survival Network.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
The Financial Survival Network. It's all about what's next.
And just joined us, we're talking with John Rubino, dollarcollapse.com. And John, you wrote an article about what's happening on Wall Street now. They keep changing the rules. What used to work before is not working now. And, you could just basically write up a report on a stock, buy GE. It's a great stock. Earnings are going to go up at 6% forever and ever, but things have changed, haven't they?
Yeah, Kerry. One of the unacknowledged victims of today's financial system is the money manager. Picture what it must be like for these guys who are running money in this world. You go to business school, you learn about cash flows and dividend yields and asset allocation theory. And so now you're in the real world where everything is manipulated. All the pricing signals that used to tell you what to do in financial markets have been short-circuited by governments artificially depressing interest rates and secretly intervening in the precious metals markets and in the equity markets. And so you're stuck with a lot of tools that no longer work. And then recognizing that you don't know what you're doing anymore. You presumably put your clients in the cookbook allocation of so many stocks, so many bonds, so much cash, depending on the age and other circumstances of your clients. But then the governments of the world manipulate equity markets upward year after year after year, so that they outperform everything else. And your clients come back to you and say, well, why am I paying you? I could buy an S&P 500 ETF and do better than what you're doing for me with no fees. And so hearing this over and over again leads you to increase the allocation of equities to your clients, and to go into emerging market funds and more aggressive stuff than you would normally do, just because you're tired of hearing that you're not doing a good job, and you see all this easy money being made in the equity markets. So you do that just in time for the equity markets to turn around, when governments run out of fuel in order to continue to pump up the riskiest part of the traditional asset structure. And now, last week, U.S. stocks had the worst week in 3 or 4 years, and so now you're stuck. You've put your clients into the riskiest possible stuff. Oh, and emerging markets are blowing up too. So now you can't win. Now you've gone from having your clients call you up to criticize you for not making enough money to call you up and beg for you to find a way to protect their capital because they see it melting away and they wanted to retire early, and now you've destroyed their lives. And so what are you supposed to do? There are no indicators out there that tell you anything useful anymore. You can't look at dividend yields. You can't look at cash flows. You can't look at PE ratios. And so you're just flying blind. And so this morning, a lot of money managers, after that horrible week last week, had to make a big decision. They had to either stay the course and hope that this bad week doesn't turn into a bad month and a bad year, and you've got another thing like 2008, 2009, where everybody lost money, and the average equity portfolio went down by 40 or 50% on the one hand, or roll the dice and assume that the world's central banks are going to pay off again on the Greenspan put and come out with a bunch of announcements about new QE programs and flood the system with cash and send equities through the roof. And neither one of those decisions is based on any fundamental factor that you know about or that you know how to analyze. You just have to guess, and not guessing, not acting is a decision in its own right. And so if your clients knew how little you know about the market, as a money manager, they would be appalled and terrified. And so your main goal now is to find a way to continue to convince your clients that you have some idea what's going on, and you really don't. You know in your heart that you're throwing darts now. You're just making things up, but you've got to make something up. So your job this morning was to come up with a narrative that justifies what you choose to do, but when what you've chosen to do is a total guess. So I don't envy these guys. Their lives have been immeasurably complicated by governments taking over the financial markets and distorting all these pricing signals that used to matter. So that would be a very tough life, being a money manager right now. And I don't think it's going to get any easier.
Yeah, well, they find out that they know even less about the market than they know about women. That's a scary revelation, John, Very scary.
Yeah, it's nice in life for a guy to at least think we understand one thing. And when we find out we don't understand anything, that's crushing spiritually.
Oh man, It's got to freak them out. I mean, here, it's like back before Columbus, you know that the earth is flat. The schools have taught you that. The church, you didn't really have schools. The church has been teaching you that the earth is flat, that the sun revolves around the earth, all this stuff. And then all of a sudden, here comes Columbus, here comes Copernicus, here comes, Galileo, and they just screw up your whole world. And, man, it was so much easier when things were simple, right?
But see, at least Columbus and Galileo replaced the old ideas with a coherent new idea. Yeah. and for today's money managers, there's nothing to hold on to, because governments are manipulating the markets for political reasons. And you have no idea what the political agenda of a given group of people might be. Because, you know, on the one hand, that they want equity prices to go up year after year. But you don't know that they have the power to make that happen continuously, because in the past they haven't. You know, nobody wanted 2008, 2009 to happen. Mm-hmm. They created these imbalances that blew up, and the financial system almost died, and they were able to fix it this time. But you don't know if they can fix it next time. You know, there's nothing in PE ratios or dividend yields that tell you anything about when the derivatives market blows up next. And whether the guys in charge, who are under immense amounts of pressure and who also don't really know what's going on because they've distorted markets to the point, and they never understood markets to begin with, whether they can fix it. You know, you just don't know any of this. And so equities might double from here very easily. And they also might go down by 80% from here.
Yeah.
And either one of those outcomes is completely possible. I mean, there's a narrative that gets you from here to there that's completely coherent. And if you're a money manager, you have no idea which one is going to turn out to be true. And so you're basically betting people's lives and people's livelihoods and people's future on one thing or another without having the slightest idea whether one is right and one is wrong.
Yeah, very dangerous. And like you say, you just don't know what's going to happen. And it could all blow up, and which is why gold and silver, only insurance policy out there, you know.
Well, historically, precious metals are where you go when you're in a situation like this, when the world is so uncertain that you start grasping at any other kind of certainty that you can come up with. And precious metals have tended to be that certainty over time. And that doesn't mean they go up dramatically in real terms in crises. It means they hold their value. And so over time, gold has tended to buy basically about the same amount of stuff, of real stuff, as it did 100 years before or 1,000 years before. You know, the old stat that you hear all the time about how an ounce of gold bought a nice toga back during the Roman Empire, and today it buys a reasonably nice men's suit. And the same is true for all kinds of other things like oil and wheat and you know, name your necessity. And so that kind of certainty becomes incredibly attractive in a world where there are no other certainties, where your other financial assets, or your house, your bond portfolio, your stock portfolio, all could do well or could do incredibly badly, and you have no idea which it'll be. and so you can buy gold, you can buy silver, you put them away, and you figure, all right, who knows what's going to happen next year? But in 20 years, they'll be worth about the same amount as they are today. And there comes a time during a financial crisis when that's good enough, you know, and so a lot of money will flow into precious metals if the craziness continues from here. And I think it's almost guaranteed that the craziness is going to continue because we haven't fixed anything. We're making the same mistakes that we made in the 1970s and 1980s and 1990s and in the 2000s. You know, we're creating too much new currency. We're building up too much debt. We're allowing governments around the world to grow too rapidly. We're distorting the pricing signals in what used to be free markets by basically taking over more and more of the economy. All of that stuff leads to financial instability.
And that's where we're going to end. So check out John's site, dollarcollapse.com. You find the link on financialsurvivalnetwork.com. Make sure you sign up for both of our newsletters. John, we will see you next week.
See you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.